Welcome back, everybody, to the uh, today's Market Explained for Four Star. Today we have an interview episode. We've got Scott Clark with us. Scott Clark is the CEO and chairman of True Life Companies. They're out of Denver, and they have a really interesting take on real estate and repurposing real estate. And there's so many ways to do real estate, and this is really one of the most unique ones. So we want to welcome Scott to our show today. Scott, welcome.
Thanks, Brian. Thanks for having me.
Excellent. Well, we want to hear all about how you do real estate. It's really interesting. This is a program that's available to Four Star. But before we do that, Scott, you're doing a lot of really interesting things in real estate. You're CEO and chairman of the firm. But tell us about your background. How did you get to where you are now, that you are in a position to be talking to us about all these things?
Yeah, certainly. Interesting story to say the least. But born and raised in Chicago, not unlike you, Brian, and our beloved Chicago, right? And
Right.
Dad was a hardworking guy, but Dad was not the college paying for type. Bless his heart, best dad in the world. And so I had to kind of do things on my own. And I might argue that not having too big of a parachute might be one of the secrets in life. So always wanted to be in California as a young man. Finally got out there in the late 80s. I'll talk more about that later. And went to work for a company out there, my dream job. And within 3 months, they went out of business. And, sometimes what's the old saying that necessity is the mother of all invention, right? So as a very young man in 1992, I started my own firm and have been a serial entrepreneur since then. I'm probably unemployable at this stage of the game. Brian, I started out in the equipment finance business, built my own firm, and monetized that in the late 90s, and then started this firm. Was always fascinated with real estate. Who doesn't want to be a real estate developer, Brian, until you get into it and realize how difficult and the kind of expertise it takes. But yeah, started out then in the early 2000s in this particular space as a capital provider to the space. And then thank God we got into the game of real estate development late in the, right before the financial crisis. We were all caught up in it and we didn't get into it too deep, which allowed us to survive through then and then launch our firm really January of 2008. And I guess we've gotten really good at when things are difficult is when we like to capitalize. So that has been the case with 9/11. It was the case in the financial crisis. It was the case then again with COVID. So serial entrepreneur and have built a firm I'm quite proud of.
Nice. Well, good. Well, so tell us a little bit about True Life Companies. What do you do and how do you do it?
Sure. Well, what we do is we repurpose, engage your imagination. I would ask everyone and picture a retail strip center that are littered across the country that maybe lost its grocery anchor. So we will repurpose that retail strip center. Sometimes it's, be commercial office space. Sometimes it might be a dairy. Sometimes it's even flat out land. We will repurpose that property from that use to a fully designed residential community, right down to typically where the sprinkler heads are, architecturally designed, landscape designed, and then we sell that to America's best home builders. And we really see ourselves as a process-driven supply chain company to America's best home builders more than an opportunistic real estate investing company.
So you're looking for unique opportunities that others are just going to pass on, and you turn it into residential. Now it's been a rough couple of years. How has real estate, residential been impacted in the last few years?
Yeah. I would add that we're now doing it in 9 states and 12 different regions throughout the country. And you're right. It's been quite a ride since, March of 20. We all remember March 16th of 20, when we told everybody to work from home. Well, none of us will forget that. Right. And most of us thought, well, we prepared for the worst, like most of us. What we didn't realize is between March of 20 and May of 22, in the regions we serve, residential real estate, Brian, went up 40%. Crazy, right? And when most of us thought, even us, supposed experts in the space figured if someone lived in an apartment, they couldn't afford a home typically, right? Well, it turns out
Mhm.
not to be the case. The industry went on to absorb record numbers of homes existing and new. And then when interest rates started to go up, you can't print $7 trillion and add it to the money supply, Brian, without inflation. So when Powell did the best he could and started raising interest rates um, in May of 22, those same markets went down about 10%. So still up 30%. And in the last 3 months, believe it or not, they're on the ascent again. And really, like most listeners to this podcast today, I'm sure we've all refinanced during the artificially low interest rates.
Yep.
So you literally have tens of millions of Americans stuck in their existing homes. Recently, I heard it on one of your podcasts. Actually, home builders were trading at all-time highs here recently before the recent sell-off,
Right.
because new is where it is, and new is up 30%, while existing's down about 20% because drive your own neighborhood and you just won't see any for sale signs, right? So it's been an interesting time. We put our younger folks in a tough spot, those who still believe in the tradition of the American dream, because there's no inventory, and at these rates, everything is more expensive, costs a lot more for them to get in. It's been incredibly resilient since the interest rates have gone up, and even caught us by surprise. And I know it caught most of our publicly traded home builder partners by surprise as well.
Sure. Well, then you're on the newer side of that. You're not on the older existing home side of that. So what do you think now that we've been through this wild couple of years, lots of inflation, residential market for new going crazy? What's your opinion of the long-term outlook for this segment?
Yeah, great question, right? And I was telling our team yesterday on an all hands meeting that I do a quarterly economic webinar. I do things like this with you. So I'm a data driven kind of nerd, if you will. And as I go through these various podcasts and look at the actual data, I am, concerned for our younger folks, future around that tradition of that American dream. There are 166 million Americans under 40, and there are 80 million under 20. So we have this massive wave of pure demographics. Our whole entire careers, Brian, when hasn't it been about supply and demand, right? So you have this massive wave, and approvals getting nothing but harder at the jurisdictional level. So we are quite bullish residential. I tell the younger folks, nothing goes straight up, right? So we'll have times of pause, times of up and down, but we partner with quite a few economics firms, economist firms. Oxford Economics is one of our main partners, and they're forecasting beyond normal last 10 years appreciation over the next 10 years. And it's purely a demographic play, Brian, of just not enough to go around. It's really what it's all about. So we're very bullish.
So there's still a supply issue. That's what we've been talking about, and you still see it there.
Oh, without question. Brian, in today, if you just, we are in what we call attainable for sale housing. We want to be the low cost provider, what we design. There are 68 million 25 to 39-year-olds in America, and there are 701,000 houses listed for sale. In the Silicon Valley, there are 750 25 to 39-year-olds per house listed for sale, and we wonder why no one can afford anything. And some of your listeners are going, well, not every millennial wants to own a home. Okay, cut it in half, cut it in a quarter, cut it to an eighth, cut it to a 16th. There's just not enough to go around, and more people are being forced out of the market because of it.
So given this condition in the market, how has that changed your strategy at True Life?
Well, it's really, well, let me tell you a little bit about our supply chain business, right? You may remember that. Picture an assembly line in your mind. Picture new deals always coming in that we're repurposing, and deals always being sold. So we've gotten more bullish on the front end, though the sales recently are coming at us very quickly. It's as busy as we've ever been with our publicly traded home builder partners. But what I'm most excited about is the front end of our supply chain, because there's very little debt available. That which is available is significantly more expensive. So the competition for that retail strip center 2 years ago, when the money printing machine was on, was pretty aggressive. There was a lot of competition for those sites. There is
Yeah.
very little competition for those sites today because the capital markets have kind of freaked out, as you know. So what
Sure.
happens to the price of the new stuff we're tying up? And we're not out of this constrained demographic, lack of not enough to go around for the foreseeable future because the wave of millennials that are coming is 166 million strong.
Wow. Yeah. Okay. So there's still big demographic shift causing the market to be the way it is.
Mm-hmm.
But one particular interest of mine, and you guys are pretty strong in that state. What about California? Everyone seems to hear
Yeah.
people are leaving. We hear all these things going on, but yet there's no housing, and they got huge restrictions. Tell us what's going on in California. That's particular interest.
Yeah. A couple of facts, again, stat guy. The average American buys their house at 36 years old. In California, it's closer to 38 years old. There are close to 40 million people in California. And yes, during 20 and 21, California lost less than 0.5% of its population. And you can imagine me out on the road show with our funds, Brian, in 20 and 21 getting pelted by the California questions because our largest exposure is still to California, though we're now spread across the country. So some interesting, I think your listeners will find this very fascinating, actually. I moved to California and spent half of my life there between 88 and 2015, where I then moved to Colorado, Denver now, right, since 15. So when I moved there, it was too expensive in 1987, and everybody was leaving. Population was 25 million. Today, it's close to 40. So between 1975 and 1990, California delivered 2.65 million houses to the marketplace with a population of about 28 million. 91, these are 15-year increments. 91 to 06, 1.6 million houses. The last 15 years with a population of 39, 850,000 houses. California ranks 49th in the nation, 49th in the nation of living units per resident. From an investment perspective, for me, it's the perfect storm of all perfect storms. For our kids trying to buy a house, it's very, very difficult, as you can imagine. So we're very bullish.
Prices.
And by the way, the prices are out of control, and and have been for our whole lives. But the population did start ticking back in the other direction, by the way, here recently. So I wouldn't bet against California for nothing. I don't live there anymore, but I would not bet against California.
Okay, so the California market's coming back, but the supply demand thing is still there. So that's why prices are up, because there's very little supply, and you're going to try and supply some of it, and there's a profit opportunity there for sure.
We're doing our best. We have about 30 sites plus in California, bringing on average 100 units per site to the marketplace, and we'll deliver 10,000 sites to the marketplace in the next 3 or 4 years, and it'll put a small dent in it, Brian. It's going to take a lot more than us, but it'll put a small dent in it. Yes.
Yeah. Very interesting. Okay, well, bullish on California. What other trends besides California do you see developing?
Well, it's interesting. None of us have a crystal ball, Brian. You don't have one. I don't have one. And I love your guest mix. I like your podcast because it gives me a better sense of what's going on in the world. Thank you for doing this. Because we all need as much education as we can get, right? Because none of us really know. I would say our partners, we believe rates are peaking. You know what's happened with the bond sell-offs, and it may be time for bonds, right? Again, Brian's 3 years in a row of negative production or negative results in bonds. It's never happened in America. So we believe that clearly the long-term rates aren't buying, the recent inversions aren't buying that they're going to stay this long for a while. We don't either. We think they are peaking or close to peaking. Doesn't mean there won't be another raise. And then you might say, okay, so I think we're in a higher interest rate world for some time. We would like to see them tick down because it makes the affordability, of course, for a lot of reasons. It makes the affordability for the younger people better. It brings more resales back to the marketplace. We think resales to the marketplace are nothing but a benefit to our strategy, because if that means that rates came down, which means a higher percentage can afford it than the resales that are going to come to market. So our kids need all the help they can get. We just know in the markets we've chosen to be in, the approvals are getting harder and harder. And we don't believe we ever catch up to the supply demand curve at all in residential. And unfortunately, it's becoming a little bit more for the affluent home ownership. And our strategy is doing everything it can to be part of that. But I'll close on the trends in that we believe residential is the right place to be from a real estate asset class. We like industrial. We think there'll be more onshoring, but we love residential.
Great. So you said the residential, this is really the best time to invest in residential. So why is it the best time?
Well, we would say that it's the best time for our strategy. I don't know that there's a bad time to invest in residential because we're never going to catch up to the supply chain. But where we're really excited, as I mentioned earlier, that because of our supply chain and the new deals coming into the process, we'll board 15 new deals into our strategy in 2023. We'll do at least 25 next year. And we know that as with the capital markets being a little interesting and will be for probably, Brian, you might agree, for the next 12 months at least, there'll be less investment in residential, meaning less competition for people trying to buy that said strip center or that B commercial office building. We think there'll be better buys there. And remember, our job is to repurpose it from that use to a much more valuable use in residential. So we just believe with the fact that people will be locked in their existing homes now for at least the 2 years before we get back to I don't know about you, Brian, I refinanced at 2.37. My wife would like to buy a different house. We're not moving, right? So it's snooze the only option. And a trend we've seen recently, by the way, first time in 20 years, the square footage that's being delivered to the marketplace is actually getting smaller. And our younger folks need that because it's still a price per square foot business. So again, yeah, we think residential will perform quite well for the next few years for sure and beyond.
Excellent. So, and around the country, why is that compared to? We know the California issue. A lot of it's regulation, a lot of it's environmental, and others. Why is it that way around the rest of the country?
Yeah, well, that's a great question, right? Because most of the stuff we read from the pundits is a nationwide kind of deal, and we know there are pockets of markets that are different than other markets, right? So what I would say is the markets we've chosen to go to, there's 10 different data reasons we go there. Largest percentage of 25 to 39-year-olds, largest percentage of STEM jobs, largest percentage of the inventory being delivered by publicly traded home builders is our three tops. So the markets we've chosen to go to have either topography issues that make development harder, political reasons why development is harder. For example, we went to Austin. We didn't go to Houston, right? Where you have more restrictive policies around growth. So we go to the most constrained demographics, both on supply side, demand side, and of course, job base. So I wouldn't say the whole country. Illinois, we won't go to. It's the taxes are too high on residential, right? So it makes the investment tougher. The markets we're going to, there's plenty of reasons we went to Raleigh and not Charlotte, but around those earlier things that I said, growth, et cetera. The markets we're in, and don't take my word for it, our partners that we partner with gave us kind of the demographics and gave us the medium and long-term outlook. And they are north residentially because of 166 million people under 40. 80% of them don't own a home yet, Brian. It's simple as demographics. Supply and demand.
It's very amazing. So are there other, you say Illinois is a state you would avoid. Are there other states that the taxes and other situations are just not attractive enough?
Yeah, Minnesota, New Jersey. I am a purist of home ownership individual. So I think you own a home no matter where you are. If you can, don't pay somebody else's mortgage, pay your own, right?
Pay your own,
but
right?
There are states where the property taxes are such that you're never really going to get the same appreciation you're going to get in the Californias, the Colorados, the Austins. Could change. And then we look at demographics, who's moving to where, right? And we know what's been going on since 2020. So where the growth is and where the lack of inventory is, first and foremost, the greatest need is for our value proposition.
Nice. Well, and then these real estate strategies are encompassed in different offerings and strategies that you offer. And we're not going to discuss those today, but you can certainly talk to any financial advisor at Four Star, and they can kind of walk you through ways to take advantage of this, right?
Sure, absolutely. We'd love to answer any questions also.
Great. Well, good. So this has been a good discussion. Scott, is there anything else? We've got about 300 people that'll see this in the next couple of months, and maybe 1,000 over the next year over time.
Yeah.
So you have the floor. You're in the conference room. They're all looking at you. Is there any other message you'd like to say to the group?
Yeah, just that one thing I'd like to say is that our entire careers, Brian, when hasn't there been something on the horizon to be worried about, right? So I might argue that those somethings, every pundit said we'd have a recession by now, right? And it hasn't showed up. It's going to show up. It's going to show up. That could be really opportunistic, right? Versus something to be afraid of, right? And you've seen it, Brian, throughout your career. there's only been 9 recessions in our entire lives, Brian. That's
real
astounding.
Yeah.
Real recessions, that the greatness of this country in economic growth, quarter over quarter over quarter. It's not, I try to tell my kids, it's not a flat line that goes up or down. It's the growth from the prior successive quarter. We're in approaching a 25 trillion economy. This money supply will shrink. They've already taken $1 trillion out of it. Inflation will come down. I think that it's like keeping a volleyball underwater, right? With inflation in the future, because you've got a lot of reasons why it could be higher. It wants to continue to pop up. So it'll be interesting to see that work. I think we're in a higher inflationary world we've been in a crazy low inflationary world for the last 20, Brian? I think we're in a higher inflationary world for the next 20, just my humble opinion, which means you want to be in assets. And I think a lot of people, look, money markets went up by almost $1 trillion. And a lot of people, including yours truly to a certain extent, missed out on the S&P's up 13, and we thought we were doing well at a 4.5 in the market, in the money market, right? We might have missed out on 9 points. So be in assets and believe in the greatness of this country would be the last thing I'd close with.
So that's great. I was going to say, I do remember, Scott, in the 70s, I was in high school, but then I got in the industry in the 1980s, and all around that, everyone would say my best investment in the 70s during high inflation was real estate. You think those same conditions hold true now?
I think they, here's why I think they unequivocally hold true, mostly in residential. You have a country of 330 million people. And since the financial crisis, we've under-delivered to the marketplace. You read what you want. CNN article says 6 million. Freddie Mac says 3.9 million. We're undersupplied by 4 to 6 million housing units in this country, with half the population, more than half, being under 40 years old, and they don't buy their first house until they're 36. I think it's purely a supply-demand situation. Doesn't mean it's going to go straight up. You and I both know it won't. But we don't invest for 1 week or 1 month or 1 year, do we, Brian?
No, of course not. These are long-term investments, and when you want a good long-term rate of return and you plan for it, this could be a very, very good category here once again.
I believe it is.
Absolutely. Well, Scott, thank you for being with us today in Today's Market Explained. Really appreciate you.
Quite welcome. Thank you for having me.
Okay, and thanks everybody for being with us on another great episode of Today's Market Explained, a 4-star podcast, video, media event, whatever you want to call it. And we will be back again soon with another episode, market commentary, and another interview with a great interview subject, just like Scott Clark. So thanks, everybody. We'll leave it there for today.
Thank you.